Break today at its run to 100, closing a bit lower.
It's still close, though. Stocks are a lot lower, though, as we begin the final hour of trading. Dow is down 232 points, and the question is, could expensive energy and then a falling stock market coupled together be the Grinch that steals Christmas if those factors curb consumer spending?
With us now, Mike Norman, founder of Economic Contrarian Update, oil trader Eric Bolling, Nicole Ridway from smartmoney.com, and Jim Pettakakis, who's assistant managing editor from U.S. News and World Report, and Peter, who is of Euro Pacific Capital and author of the book Crash Proof. Let me go to Jim first. Jim, on oil, how much of an effect does that have on the market? Because after all, we saw oil go up yesterday and market was up. We saw oil go down today just a tick, but the stock market is way down.
Well, I mean, I think in the short term, and as you just said, it's tough to say what the market and oil are going, how they're going to react on any given day. But I think really over the longer term, the effect of oil on consumers has been vastly overrated. We really saw the equivalent of $100 a barrel oil really last summer on consumers. We had all these refinery problems which shot up gas prices to really the equivalent of $100 a barrel. And guess what? The consumer kept spending. Really, the hidden story of this economic boom has been the growth in wages and incomes over the past 3 years, and that's really helping offset a lot of these price rises we're seeing in oil.
You should see Eric Bolling's face. He's like this, Jim. He's going,
not mad at me for once.
You know what it is? It's just that we've had a $30 move up in oil, and we haven't had that gasoline price. But this is the right price. Last year, when we saw that big increase in gasoline prices, it was way too high. Refiners were making too much money. They were gouging us. We were putting money into their coffers. You got to look at the refiner charts. They're off the top of the chart, making so much money, and now it's correcting. I've traded for 22 years. Gasoline profit margins, I don't want to get too complicated, the money that they're supposed to be making is about in line right now. $5 or $6 a barrel right now is right. It's what it's been for a long time. It spiked to $35 post-Katrina, but now it's back in line. So this is okay. I beg to differ in that. I think these are more normal prices.
No, my point here is that a lot of people they see the big round number, $100 a barrel, like that's going to push us into a recession. I mean, that's just not going to happen. This economy is far more resilient to high oil prices than it was back in 1980. Plus, you have all that money which is flowing out of the country to to OPEC. That money also flows back into the country in the form, and they're buying bonds, stocks, lower interest rates, higher stock prices over the long term. And any given day, of course, the market can go down.
Mike.
Very good point that Jim just made. There's somewhat of a circular flow. In addition, let me just say this. The United States is the third largest oil-producing nation on Earth. 7.5 million barrels a day. We have a huge oil industry here. So while, up here in the Northeast, we feel it, folks down in the Gulf states, in Texas, out west, there's a boom going on out there. So that's another sort of a circular flow back into the economy, high levels of investment. What are you looking at me?
I'm just
What are you looking at me like that for?
I might have been agreeing with you.
You should have seen they were like,
my head off.
He might have been agreeing with you.
Agreeing with me for once?
So far, keep going. Let's see.
I'm done now.
I know who's going to disagree on some level. Peter Schiff. So, Peter, what do you think? I mean, if $100 oil is or is not going to put us into recession, and I know you're going to say, we're already in recession. Not yet.
Yeah. When it comes to consumer spending and Christmas time, consumer spending, excess consumer spending is how we got in this mess in the first place. Borrowing to consume is not economic growth, it's economic suicide. I warned last week on this program of the ticking time bomb in credit card debt, that this was the next subprime, and you just reported on that earlier. And, I think this is coming. I don't know if it's going to hit us by this Christmas, but certainly by next Christmas, Americans are not going to be able to charge Canada's credit cards. Limits are going to come down. Credit is going to really tighten up, and Americans are going to finally stop spending.
And you'll officially be the Grinch who stole Christmas, because you will have forecast the whole thing. Listen, there has been no pullback in consumer spending. I want to go back to this point of wages now rising at the fastest pace in a very long time. And yes, look, let's be honest. Nobody likes to go and fill up with gas and pay $3 a gallon, $3 plus. It hurts. It certainly hurts middle income and lower income people. But it has not had the devastating impact on the economy that many would have predicted, several years ago. Look, we're at $100. We went from 10 to 100. We're just, 4% off on the Dow.
Yeah.
The economy's posting 4% annual growth rates. it's pretty darn
By the
good.
way, Jim, we should mention
But
today,
Mike, you know
today, Jim, Walmart was doing pretty well. It was one of the few stocks that was up. We have our friend Toby Smith saying that, in fact, his experts, and he's put together a lot of group of people that track these things year after year after year, say that consumer spending is not going to be hit by Christmas. What do you say?
Oh, I don't think so. I mean, again, really, the untold story here is that both wage growth and income growth since 2004 have been extremely strong. I mean, you look at Walmart, the company that's supposed to get hit by higher gasoline prices because it's supposed to hit their demographic more. We just talked about that. And you want to look at stocks? Look at Google. Look at Google. That's sort of my new market bellwether. If we're really going into the tank, there's no way Google would be almost flat today, given their PE ratio. They have their hands in so many parts of the economy. Advertising, all that. There's no way they would be flat, I think, if people are that worried about us going into a recession.
You're talking about all this extra income. We're earning more dollars, but the dollars we're earning have less purchasing power. Measure our income in Canadian dollars. Measure our income in Australian dollars.
I'm not buying Canadian products right now. All right, I'm not buying.
Exactly.
No, but ultimately,
listen. What's been keeping this market?
Our standard of living is determined by the value of our currency. Our prices are ultimately set by the value of our currency.
Hold on,
yes,
Peter.
they
hold
are.
On, Peter. Hold on. Go ahead, Jim.
Listen. The wealth of this country has gone up by $20 trillion over the past 5 years. And you know what? Even with the decline in the housing market, we're still up immensely. Wages up. Income up, market up.
Okay.
That's what's been keeping this economy growing.
We only have a trade deficit 5% of our GDP. That means
it's going down.
We produce 95% of what we consume. We only take in 5% from the outside world. So our standard of living is not going down.
Okay, zip it, everybody. Shh.
Yes, it is.